Well, welcome to the 2014 Step 2 Advanced Education Program. For those of you who are watching this subsequent to the presentation, this is March 11, 2014, and today's topic is insurance as a capital asset. Before we actually get to that, though, there are a couple of administrative details that I'd like to go over. So I just want to go over just review what the program is going to be doing this year for the advanced program. And I want to show you the advanced program website page, and then we'll get into the presentation. So just to review, of course, we have the advanced program education, and there are 4 sessions. There's a calendar of those sessions on the website page, and you've also, hi Alex, welcome. You've also, I'll be showing you how to get into that in a few minutes, but there's a calendar. We have the base Step 2 program sessions, of which there are 4, and we have the advanced program sessions, of which there are 4. This particular session about insurance is kind of coupled with the one of the other ones, which is about insurance trusts. Insurance policies are, of course, the main investment of an insurance trust, and insurance trusts, of course, have a lot of technical issues that need to be complied with on a regular basis, one of which is to make sure the insurance policy is current and actually what's the best that's available on the market for that particular purpose. And so this particular session is kind of a way of talking about the investment of insurance trusts for those of you who have insurance trusts. But of course it also stands alone for anybody who has just an insurance policy or policies. And as I've said before, we have in our Step 2 program about $75 million worth of death benefits that are in the assets under planning among our various different clients. So insurance is it's the largest asset class that we actually have as assets under planning, and so it's important for us to make sure that the clients who have large policies and have policies that are important to them understand the ins and outs of why it's important to maintain that as an asset. So let me just one of the other things about the program is the personal planning update. When we originally thought about having the advanced program this year, we didn't consider doing that, but then as we were preparing the welcome letters, our use of the GoToMeeting session or technology as we're using today became so obvious a way for us to have meetings with people who are at disparate places. So we're planning to have personal planning meetings for our clients and their families that are scheduled. So when you're ready and you'd like to start scheduling that, you should get in touch with Alicia, and we'll start setting up dates. It's important to try to get that started because if you have a bunch of people who are going to be on the call, it's going to take a while to find a time when everyone can actually attend. I did that once with a family, which there were 4 people, all at different places, and it took us about 6 months to find a time when everybody could be on the call together. One of the other things that I want to point out also of the program is the First Call program. It's really not a program, it's just kind of a privilege or a right. It means that, and a lot of the Step 2 program members don't realize this, and it's important for the advanced program members as well. You have the ability to call us up and get the benefit of our experience with respect to any issues that you may have, and it's part of the Step 2 program, so you don't get charged. We don't actually go on a time clock unless it turns into a project, in which case we'll let you know that it's turning into a project and talk about what the fee might be. But calling us up is at no extra charge. I don't want to say it's free because you are paying for the Step 2 program. But the point of it is that we want to make sure that people have the ability to ask us first, give us the first call when a question comes up before mistakes are made or problems come up. I also wanted to just remind people about the Care Call program. That's the program that allows us to have you on the CareCall website, so that if there's an issue with an automobile accident or some kind of an emergency, the emergency workers will have not stamps, but will have stickers that you can put on your license, and they'll see those and be able to call CareCall to get information about who has the authority to talk to the medical personnel, for example. And CareCall will also call people that you asked them to call, and you do that by signing into the website and telling them what you want to do. But as I've told people before, the first year I got my CareCall package, we thought it was an advertisement and threw it out. So be on the lookout, because it should be already there or on its way to everybody in the Step 2 program. That gets Rose sends out a new package to everybody every year, so be on the lookout for that. So I just wanted to show you the website page, and so I'm going to tab over to the actual website. Okay, so this is the Heritage Design website. This is the front page right here. And before I get started, I want to show you that under services, we have the various different types of services that we do listed. So that's a drop-down menu there. But you can't see the advanced program page unless you actually sign in. So how do you sign in? Well, the sign-in is down here on the lower right-hand corner of the page. And so the sign-in for the advanced program is Step 2 Advanced, all lowercase, so it's STEP2 Advanced. And the password is year 2014, just all together with small letters, YEAR 2014. So if you do that and you sign in, you'll now see under the services list, you've got the Step 2 Program Resource Center, which we've shown to everybody in the Step 2 program, but you also have the Step 2 Advanced Program page. And so if you click on that, you come to this page. At the moment, we don't have a lot of resources on it other than the online class schedule and the education program description, but we'll be putting links on this page for these presentations so that everybody can see them at a later time, and we'll be letting people know about how to log in if they don't know already. So that's the web page. That's how you get to the website's page for the advanced program, and we'll be adding things on. If you have any ideas about what you'd like to have on the advanced program page, please feel free to let us know. It's easy enough to put resources and other materials up here with links or whatever, and we're happy to do that. So without further ado, let me just introduce John. John Franzen is an insurance advisor. He used to work in a general agency called CPS Elite Advisors Insurance Services. A general insurance agency is one that has direct relationships with the insurance companies and has a lot of agents under it who sell insurance, and the general agent essentially supports the agents who sell through it. In John's case, his job was to evaluate insurance policies for people. So if an agent came to you and said, let's take a look at this insurance policy you have and see if it's working properly, John would get the project, and he would make the analysis to determine whether the policy there should be a new policy, have it replaced, or otherwise. And after a while, John kind of got discouraged with this, because he knew that all of the clients realized that, or at least they thought, that what he was doing is really just another way to sell more insurance, because what the agents were looking to John for was the ability to provide a report to the client that said that they should substitute a new policy for the old one, and then of course when the new policy got substituted, the agent gets a commission. So John got kind of discouraged with that. He realized that people were saying, well, you know, that's a nice report, but really that's all, it doesn't have that much credibility with me. This is the clients. It doesn't have that much credibility because really you're just using it to sell a new insurance policy. So John woke up one day and decided, you know, I think I'd rather do this another way. And what he did was he left the agency. He gave up his license to sell insurance, but kept his license to actually analyze insurance. And in Massachusetts, you have to have a separate special license in order to provide advice about insurance without being paid a commission. So John has that licensing, and so he now does not sell insurance. All he does as an insurance expert is to review policies and explain how they're working and help people understand what they should do with them. So he's very much like an asset manager in that way, and he charges fees for his services. So he's fee only. He doesn't accept any commissions. He doesn't sell any insurance. And for that reason, I decided that it would be a good idea to introduce him to the Step 2 program. He's actually also spoken to our Heritage Design partners at one of their conference calls, and he made a similar presentation to what he's making today to them. This one, of course, is tailored for our Step 2 program members, and I'm hoping that you'll find this useful. So, John, let me just turn this over to you. I'm going to turn the keyboard. I'm going to change the presenter to you. And here you go, John. You are now the presenter.
Excellent. And thank you so much for the introduction, Frank. I really appreciate that. Can everyone see the screen?
Yes.
Mm-hmm. Okay,
great.
Yeah.
All right. So the topic today is life insurance as a capital asset or as an asset class. And I like to start off with just the anatomy of a life insurance contract. And it begins with the face amount, obviously. We're all familiar with that. And in some policies, there's a cash value, which are essentially premium overpayments, and they grow tax-deferred at interest or dividends. And what I like to talk about in these types of presentations is the insurance corridor, and that's the net difference of the face amount and the cash value. Okay. One of the things that a lot of people are unaware of is the cost of life insurance. And with a term insurance product, it's fairly straightforward. You're essentially paying a specific premium over a level period of time, and it's really the purest form of life insurance in the sense that you're not buying anything else other than protection for a specified premium over a specified time. The more complicated policies are the permanent insurance policies, and it's an estimated premium over a specified period of time. And I stress the word estimated premium because there are variables that determine how much face amount, premium, and longevity the policy has. Okay? So what are some of those variables? On the positive side, you have an interest crediting rate or dividends, and essentially when you overpay a premium in a permanent insurance contract, the overpayment is parked in a cash value account which accrues at interest. And depending on what the interest and the dividends are paying, they subtract out the costs, and the net difference either gets added or subtracted to that cash value. The policy costs can include the insurance costs, premium loads, rider charges, admin expenses, mortality and expense charges, and surrender charges. And all of these costs are deducted from the premium, and if there's insufficient premium to cover those costs, then they will be deducted from the cash value. Now, I'm going to give an example where there's a universal life policy with a $2 million face amount. There's a policy value of $500,000 and an annual premium of $20,000. So in this example, the net amount of risk is $1.5 million. I think of this number because if you take this $2 million face amount and you subtract the actual value of the policy, the $1.5 million is what the insurance company has to come up with in the event of premature death. And the costs are based on this $1.5 million amount because they're not going to charge you costs on your money. They're only going to charge you costs on what they're exposed to. And you make interest or dividends because it's a universal life policy. We're going to credit interest. And I just picked a number, 5%. It's a little generous for today's market, but I used 5% in this example. And on $500,000, 5% equals $25,000. Now, the policy costs will be deducted from the premium payment, and if the costs are higher than that payment, the overages are then deducted from the accrued interest. And lastly, if there's still costs exceeding the premium and the interest, then it is deducted from the cash value. So I color-coded everything. I like colors because people can identify with colors better. The green is the face amount, the blue is the cash value, and the interest that is accrued to the account or credited to the account. And then you have the base or the amount at risk and the costs in orange. So same numbers, $2 million in the base amount, $500,000 in the policy value. If the policy costs on $1.5 million are $30,000, here's how the math works. You have a premium payment of $20,000, so the $20,000 is subtracted from the $30,000, leaving a outstanding balance of $10,000. And then because the $500,000 generates $25,000 in interest credits, you then subtract that from the $30,000. I'm sorry, the $10,000, and then you're left with a net gain of $15,000. You add this to the cash value, and then at the end of this calculation, that's what happens when your policy is in a positive position in regards to how the interest and the costs are credited to the policy.
John, this is Frank. Frank, can I just interrupt for a second? We're getting, I guess we're getting a lot of feedback, so I guess we better ask everybody to mute yourselves on the right-hand side. So all you do is you click on the telephone that's next to your name under the attendees list, and then we shouldn't be having any more feedback. So thanks, everybody. The only person who shouldn't be muted, of course, is John. So go ahead, John. Sorry.
Thank you, Frank. I appreciate that. So with the next example, I'm going to show a policy that's in a negative position, and the only number that I changed is the insurance cost. Instead of $30,000, it's now $60,000. And I run the math the same way. You have $60,000 cost minus the premium payment of $20,000, and that leaves a remainder of $40,000 outstanding. The interest credited is $25,000. If you subtract it from 40, that leaves a negative balance of $15,000, which gets subtracted from the account value, leaving a final value of $485,000. Does anybody have any questions at this point? You can unmute and ask if you'd like. Okay. So in my experience at CPS and everything that I've done thus far, over 90% of the insurance reviews that I've performed required significant changes. Some of those reasons include the insurance needs change, tax laws can change. Right now we're in a historic low interest rate and dividend environment. Insurance costs have increased, people are living longer, and sometimes there's improper design from the beginning. Now, to make an example, I bring in Bob. He's a 67-year-old male. He bought a universal life policy 6 years ago, and the face amount on that policy is $1 million. He funded it early on with substantial premiums, about $63,000 a year, and after 4 years he stopped. And a few years went by, he enlisted my services to see how the policy is performing, and he wants the death benefit to stay in force to age 90. So in the review process, I begin with a discovery and information gathering process where I work with the Trusted Advisor Network, attorneys like Frank or CPAs, wealth managers, financial planners, and we evaluate the insurance need to see if he needs the full face amount, or do we have to add more, or do we have to reduce it. I get the proper authorizations that I can request information from the carrier, and then I go to work reviewing the policy and ordering illustrations. The second part of the review process is the analysis of that information. I calculate the cost of insurance, how the policy is performing, the net gains and losses, what fluctuations, if there's any trends for those costs and interest crediting rates. I calculate all of that as part of the analysis, and then I apply those calculations and create simulations on how to achieve the insurance needs with maximum efficiency. Now, this is a illustration. You might have seen one if you've ever looked at your insurance contract. And what a lot of people will tell you when you look at this is you have a guaranteed side and you have a non-guaranteed side. The guaranteed side is showing maximum charges and the minimum crediting rate that's built into the contract. In this case, it's 4%. So with maximum charges, this particular policy would lapse at age 76. On the non-guaranteed side, with current insurance charges, and right now the current rate is the minimum, you're looking at a policy that's going to lapse at age 85. So to the spirit of the example, the client requested the the coverage be enforced to age 90, and clearly we're coming up shorter than that. But other than just seeing these lapse, rows in this illustration, what do all these numbers mean? And that's part of what my analysis does. I graph it onto a chart so that you can actually visualize and see what the policy is doing. Now, I talked about the insurance corridor at the beginning of this presentation, and the cost for this blue area is the policy value. This orange area is the exposure that the carrier is facing in the event of death. The cost is calculated from where the beginning of the orange line and the blue line meet to the top of the chart, which is the face amount. And through this illustration, we can see that over time, the policy value is decreasing, at which point at age 84, this particular client is no longer going to have coverage. Through the simulations, what I can do is I can modify the criteria. For example, this is the control group where the face amount is $1 million and no additional premium payments are going in. That is what the original illustration when he bought the policy was supposed to do. It was supposed to go out longer, but now that interest rates have gone down and insurance costs have gone up, the policy is lapsing much sooner than expected. In order to correct this, I can simulate different scenarios. One of them being, what if we started paying $9,000 a year to increase the premium? And as you can see, by adding in $9,000 a year in premium, that brings the longevity to the contract to age 91. I can also reduce the face amount and drop it from $1 million to $500,000. Now this insurance corridor is much narrower, therefore the costs are reduced substantially, and as a result, we don't have to put in any additional premium, but because the face amount is reduced, the policy is healthy and it goes out to age 96. I can do a hybrid approach where we pay additional premium and we reduce the face amount, and we can see how that plays out in terms of what the longevity of the contract will be. And you can see that it is a very healthy contract in terms of policy value. You can see that of all of them, this policy value grows and maintains the longest. And then once I do the simulations, I can then come back and reorder the updated illustrations from the carrier, and you can see where paying a $9,000 annual premium, that brings you out to age 92, which is very, very close to what the simulation has predicted. Now, with the simulations, we're able to quickly assess the policy structure and the criteria in order to maximize the efficiency of it. And it's not as accurate as the illustration from the carrier, but it gets us close enough so that we can save time in ordering the right illustrations rather than just throwing darts at a board and hoping we come up with the right type of illustration. The other thing, too, is that I've noticed using my simulations, doing the calculation of the costs, I've actually caught a couple of carriers not running their illustrations properly. So sometimes it's a way to double check what the carrier is doing, and they make mistakes just like everyone else. Sometimes you ask for something and they don't run it the right way, and you're making a decision based on misinformation. So the simulation is a way to double check to make sure that the carrier is running it properly. And then lastly, it's easier to understand the information due to a visual aid rather than just on numbers alone. And that's how my brain works. When I look at those charts, I can understand how the policy is working a lot better than just a table with a bunch of numbers on it. So at this point, I'm going to pause and see if anybody has any questions regarding insurance corridors. I know that I compressed a lot of information into a short time period, but if you have any questions, please feel free to ask.
Yeah, I have a question. This is Alex.
Hi, Alex.
Hi. So at the end of the day, this is something you want to do once every year, every 6 months? What do you recommend?
That's a great question. The next part that I'm going to get into is managing life insurance as an asset class. And through the management, I always recommend that at a minimum, you're recalculating the illustration every year. What I do for the management services is that I actually call all the insurance carriers of all the policies that I'm managing, and I'll actually ask them what have, if any at all, what changes have occurred since the last month that I called. Has the insurance cost increased? Have the interest crediting rate decreased? Or has it increased? I mean, it all depends on what the policies are doing. And as soon as there's a change and the path deviates from what was reviewed, I'll contact the client and say, okay, here's the deal. When I calculated your policy a couple of months ago, this is what we were looking at, but since then, the insurance costs have increased or your crediting rate has decreased. And I reran everything, and this is what it looks like now, and in order to correct it, we have to take certain measures. And that could vary, but at least the client is aware that someone's keeping an eye on what the policy is doing. Because, Alex, the problem in the life insurance industry is that people sell these policies, but then the management of them is very, very minimal. So you'll buy a policy and you'll think that if I pay this premium every year and I do my part, I should have this death benefit for what the original illustration forecasted. And what ends up happening is variables change, and then all of a sudden you're 80 years old and you're getting a lapse notice in the mail, and you were supposed to have the policy go up to age 90 or 95. And unfortunately, at that point, it's tough to make up the difference, but that just strengthens the message of always maintaining these life insurance policies and always checking up on them. And I say an annual basis is definitely what I would recommend at a minimum.
Yeah, there's one comment I'd like to add, and that is that the insurance agents and brokers, at least, and John, you'll have to correct me if I'm wrong, do not have a real incentive to call up a client if they can see that a policy needs more premium for two reasons. One is it's kind of embarrassing for an agent to call up and say the insurance company or the policy isn't performing the way we originally expected it to. But so in order to make up for the loss here, we need you to put in more premium into the policy. Nobody likes to hear that. And the second thing, of course, is that when clients get a call like that, at least if I were to get a call like that, the first thing that I would think was, oh, he's just trying to get more premium in so he can get more commission. So it's very difficult for insurance agents and brokers to broach the subject of whether a policy should be reviewed, and if it is reviewed, what should be done about it, because people they don't have any third-party credibility, essentially. It's very difficult for them to have any real credibility in terms of what they're saying at that point.
Frank, can I ask something?
Yeah.
Absolutely, Sally.
I'm feeling terribly naive, but any insurance that I've known about, you make a contract when you start out, and for so much premium, you are promised so much payment upon death. And is that not true?
That's a great question, Sally, and the answer to the question is it depends. There are some contracts that have guarantees built into them, and to what extent the guarantees are varies from contract to contract. Generally speaking, when you sign a contract, you're right, it is a legally binding agreement between you and the insurance company, and if you read it carefully, they'll actually have a fee schedule, cost schedule of what the costs are. Every year you get older, the costs increase. They'll actually tell you what that is. And then on a different table, they'll actually show you what the highest charges in that contract could be. So if you remember, I'm going to back it up a few slides here. If you remember the illustration that has the guaranteed side and then the non-guaranteed side, basically what the insurance company is saying for this particular contract is, on the guaranteed side, if you pay $9,000 a year, you will have a $1 million death benefit at age 77. But that is at the highest cost charges, and that's not very attractive. More likely is something that's going to be in the middle here. I mean, I doubt that if this client started paying $9,000 a year, it's going to make it to age 92 without any hitch. I mean, I think that somewhere from 25-year period, something's going to change. The interest rate, even though it's at a minimum, that might go up. That could help the contract. The insurance costs could increase. That could work against the contract. So generally, when you look at an illustration, just as a snapshot, what I tell people is what you can probably expect is something between the guaranteed side and the non-guaranteed side. It's probably not going to go out to the full length of the non-guaranteed side, but it's probably not going to end right at the guaranteed illustration. You're probably going to find that the policy is going to be enforced somewhere in here. And that's what a lot of people don't understand is that range. How do I calculate that range? And without going into too much detail, I do have ways to simulate what realistically you can expect. I can actually put in a premium and say, if you want this policy to go to age 90, I can simulate how much premium it'll take, and I'll run a Monte Carlo simulation to see out of 1,000 different insurance charges and interest rates, if you pay this premium, do you have a 90% probability of making it to age 90, a 99% probability? That's one service that I can offer a client. But I digress. Did I answer your question about the contract aspect of it? I guess directly I want to say that there are guarantees in the contract, which is what you see on the left side. But what a lot of people think they have is on the right side, which is the non-guaranteed aspect. And that's why people sometimes, when they're in their 80s, they get these lapse notices because the longevity was greatly reduced because variables change.
Yeah, I think I understand. It's the kind of policy that you choose to buy, that you choose to enter into an agreement on. Varies. So what I suspect for myself is that for so much a year I am guaranteed a benefit, and I don't remember what year it went to, but it was probably a good long time. What I'm wondering is, suppose suppose you outlive your year. Do you get nothing, or do you get a surrender value?
That's a great question. I'm going to just go back one or two slides here. Let me go back to the original. This is the original illustration, or I'm sorry, this is the current illustration for this particular client. And right now the client is 67 years old. If his premium schedule, based on what he's paid and the interest carrying forward, shows that this policy is going to lapse around age 84. If he dies at age 76, he doesn't get any of this money, but in turn he gets the difference between what the policy value is, what the policy value is and what the face amount is. So it's actually, I hate to say it this way, but from a rate of return perspective, he gets more, it's in his best interest to die before the policy lapses and get this exposure that the insurance company is essentially going to have to pay out rather than trying to recapture premiums that you never use. Does that make sense?
No.
Okay.
No, it doesn't. If he dies at, say, age 76,
Mm-hmm.
why doesn't he get $1 million?
Oh, he does. He does get $1 million. Yes.
So,
He gets,
so then,
this is just showing how much of the $1 million is his money, but he gets the $1 million. Oh, absolutely.
oh, okay, and the blue is what he's put in.
Correct. Yes.
Okay, okay. So, all right, I guess I feel I don't care about that. What I would be concerned with is the security of my investment, knowing that every year I put in a particular amount, and regardless of interest rates or anything else, when I die, my heirs will get that face amount.
Right. And that is precisely why I stress the importance of maintaining the policy to make sure that that benefit is going to be there. Because I'll be frank, when people pay these kinds of premiums into these contracts, they're not doing it because they like to. They're expecting the company to pay out a benefit that is greater than the premiums they've put in. I think that's a reasonable expectation. And where people get upset with insurance or life insurance is when people pay in premiums all these years, but because they didn't monitor the performance of it, when the policy comes up short, that's when people have a lot of frustration and get a bad taste in their mouth from that experience because they said, hey, I've been paying $20,000 a year like I was supposed to. I lived up to my end. Why didn't you live up to yours? But when you read the fine print in the contract, you can actually calculate where it went wrong and why you ended up with a shortened longevity.
So I think what you are trying to convey is that you better read the fine print.
That's one aspect. You should definitely read the fine print, but then you have to apply the fine print to your contract and your life situation. So if
Well,
you need
you have
to a certain age, you have to read the fine print and then use the fine print, all the calculations they use, and see how is that going to progress forward. And then I can run different simulations and Monte Carlos on what the probability, because I am not the insurance company. I can't guarantee non-guaranteed values. The insurance company doesn't even guarantee non-guaranteed values. But what I can do is I can take the cost structures that I know are in fact up to this point this is what they've been, and I can simulate what they are projected to be and what the likelihood is of your premium dollars making it to a certain age with that death benefit. Did that help answer your question?
somewhat.
Okay. I'll tell you what, if you want to have a separate session, I'd be happy to actually show you the simulations real time, and maybe that'll help you understand it a little bit better. I do want to move on at this point just because we are about 15 minutes away and I have a lot of material to cover. But
Yep.
if you want to hang around, Sally, I'll be happy to continue on our conversation about this, and you can feel free to take as much time as you'd like.
Okay, thank you.
Oh, you're welcome. So the next portion of the presentation is initial policy design. And for this example, my client Bill is in a high tax bracket, and I have new focus in parentheses there because I just wanted to make a side note and say that the federal government has really put the whole estate tax issue to bed. They've given their exemptions, and they know the calculations moving forward. So the federal government is not really going to stress estate taxes so much anymore. And the new focus that they're focusing on is income tax. That's one area that I think is going to get a lot of attention in the coming years with Obamacare and the 3.8% tax that they've added on, and just the higher tax bracket, the higher capital gains taxes. These are all ways that the government is now targeting high net worth individuals to bring in additional tax revenue. And one strategy that has always been in the marketplace but wasn't really attractive because we've been in a lower tax environment is the ability to accumulate wealth tax deferred and then withdraw that wealth in a tax advantaged manner. And that's what insurance policies, if structured properly, can provide. For this example, Bill is 50 and he plans on retiring at age 66. And by using life insurance as a tax shelter, he can realize an income tax-free disbursement throughout his retirement using this policy, as well as an income tax-free death benefit throughout the contract's longevity. And one thing that I do for clients is initial case design, where they may have all these different companies to choose from. How do you know which one's the best? So I come in and I have access to all these carriers. I have relationships with all of them, and I run all of these illustrations myself. And basically the criteria used was Bill wants to pay $30,000 a year for 15 years. And then at the end of 15 years, he wants to take an annual disbursement for 20 years. So from age 66 to 86, he's going to get this column income tax-free depending on which carrier that he picks. Now, a lot of insurance agents in the field, they're very good at selling. They're not as good as analyzing. And they typically rely on someone behind the scenes to run all the different illustrations, and then once it's presented to the agent will go to the client and show them all the different options, and then they'll pick which one that has the most sense for them. It could be the best numbers. It could be the strongest financial ranking. I mean, it all depends on what the client values in terms of the different criteria in the policy. So with this particular structure, the death benefit is level. So from day one, there's a level death benefit, and they're trying to grow money inside of it and then take this annual disbursement. One of the things that I do is I'll do what's known as a tailored death benefit, where I start the death benefit high enough so that it still qualifies as life insurance, but it's low enough where you're not paying any unnecessary insurance costs. And by doing so, you can see the disbursement. Everything else is the same. They're still paying in $30,000 a year. They're still paying 15 years worth of premium. But you can see that annual disbursement is now $41,000. And I'm going to go back to the previous level slide, and you can see that it's $32,000. So that's a quite sizable increase on a tax-free basis by tailoring the death benefit versus just using a level death benefit. Okay. And then lastly, one other set of illustrations I'll run is what's known as an ECV, or an enhanced cash value. And this is a tailored approach, but with this ECV rider, they actually give you access to your cash value at an earlier age. So what that means is if I took two illustrations, this is a level, this is just a regular tailored approach. If you pay in $30,000 in premium, your surrender value in year one is just over, or it's just around $16,000. If you put on this enhanced cash value rider, you pay in $30,000, but then you can see you have much greater access to the premium that you paid in. So if you have second thoughts or cold feet about moving forward with this, or if you decide that in a couple of years the initial illustration was much different than what's actually happening, and you say, I want to get out of this, this enhanced cash value rider will allow you to bail out and still keep much of the premium that you paid in, whereas without that rider, you're going to pay some pretty steep surrender charges. And when you look at the level approach versus the tailored approach, you can see that the $30,000 premium is now reduced to only having access to $8,000. So there's how you structure your insurance from the get-go plays a large part in how that insurance is going to perform. Okay? And then one other thing that I run is not all policies are going to be able to perform at what they were originally illustrated at. So what I did for this particular example is I reduced the crediting rate by 1.5%. And what this is supposed to showcase is you have your original illustration that looks great, and that's the reason why you sign it. Well, what happens if the interest rate drops by 1.5%, or what happens if the insurance costs increase? What does that do to the growth or the performance of this policy? And as you can see, you're still going to have that level face amount. You're still going to pay in that $30,000 over 15 years. But if you look at the disbursement, now you're looking at $9,000, whereas the previous example, you were looking at around $30,000. But if you tailor your death benefit and you monitor and you keep on tweaking it every single year, even though the policies are underperforming, you're still paying the $30,000, you're still making 15 payments. Your disbursement, it might not be as much, but it's still a pretty decent disbursement given the circumstances. So I'm just going to go back to the previous slide. This is if you just bought the policy, you put it in a safe deposit box, and then it underperforms, and then when you go to retirement, you open it up, and all of a sudden, you're not going to get $30,000 a year, you're going to get $9,000 a year. And in this example, if the policy is actively managed, yes, for the next 15 years, the policy underperformed, but you're still getting $32,000 as an annual disbursement. So it's not a total wash. I mean, you're still going to get some value out of this policy. And then lastly, I run it with the enhanced cash value rider just to show you what those numbers look like. And as you can see, the disbursement is right around the tailored example, and you will have access to your cash value in the early years and on with this rider. Okay, so the importance of managing life insurance as an asset class is it's pretty straightforward. You manage your investments. You don't just buy stock and forget about it. You have a portfolio manager or a wealth manager who's going to look at all the different investments, and he's going to make sure that if something doesn't look as promising as it did when they first bought it, they change that. So why not that same approach with insurance? And what ends up happening with, or what happens to the policy when interest and dividends decrease and no action is taken? And I put in parentheses no notice because the insurance company is not required by law to notify you when the insurance costs, when the interest increases or decreases. It just happens. So unless you're proactive and looking at your policy on a regular basis, they have no duty to notify you that the policy interest or dividends went up or down. And the same is true with insurance costs. They're not going to send you a notice in the mail saying, by the way, our actuaries recalculated your policy or your group of policies, and now we have to increase costs. So these are all things that will affect the performance of the policy, and that's why it's important to manage it. And then lastly, there's always life events that change the design of the policy. Maybe there's a divorce, you have different beneficiaries, maybe you have grandkids. Those are all factors that are going to change the policy or the design of it or the purpose of it. Okay, and I basically summed it up on one grid. You can see the yellow is the level, the white is the tailored, and then the green is the enhanced cash value. And you can just see the top three choices from each grid laid out and see how they stack up compared to one another. This one is if the policy performs as it's illustrated, and then this next slide is if it's underperforming by 1.5%. And then you can see how the different structures stack up against each other. The tailored approach is absolutely superior, and this is what good agents will do for their clients. But every now and then, I'll run into something where the policy just had a level death benefit because that's what the agent was given by his back office, and then I run into situations where the benefit they thought they were going to get isn't going to be where it needed to be. Does anybody have any questions about the case design or anything like that at all?
One question, please.
Sure.
So how do you go about changing something you bought that was told to you incorrectly?
That's a great question, and the answer to that is I have to analyze the policy. I have to look at what the policy had done, what it's currently doing, and then I have to project what is it going to take to get it to where you need it to go. And I always disclaim that I'm not a miracle worker. I cannot undo damage that has already been done, but I can control the damage and help you achieve the most efficient results based on what's available and what your budget and what your financial plan entails. And it's something that I've been able to sell for some policies that actually got them very favorable results, and then other policies, they were just too far gone, and it really wasn't something that I could come in and really correct without substantial premium or reduction in benefit. So it's obviously a case-by-case basis, but depending on how far in you are with the policy, you do have options, and the sooner that we explore those options, the more favorable the results are going to be, and that's unfortunately the nature of the beast.
So you would provide the service to be able to contact the insurance company and make those changes, either decrease the life of the policy or increase the age limit or decrease the age limit?
Initially, I won't want authority to do anything. Initially, I'm going to gather information, I'm going to run my analysis, and I'm going to go over it with the client and the Trusted Advisor Network, and collectively we'll make a decision and find out. Because insurance is only one piece of the financial puzzle. And I welcome the opportunity to collaborate with the other trusted advisors, because maybe the wealth manager or the financial planner or the attorney has ideas on how we can make up the difference. If you were using an insurance policy for estate tax purposes, well, maybe the attorney can use some gifting strategies, and you don't need the full amount. We can reduce that amount to help control some of that damage. But I don't get into what CPAs and attorneys and wealth managers advise, because I'm not licensed to talk about those things. But those are very important aspects of designing an insurance plan. And once we decide, after looking at all the information and what we're able to do, then I can go in, and if you want to give me authorization, I'll go in and I'll actually make the necessary changes with the policy according to what was executed. And with all the analyses that I do, I always give a final report that you'll have for your records, and the attorney will get one, the wealth manager, everyone who's involved will get a copy of this report, so that in the future we can always reference it and say, this is what was proposed, this is why we did it this way, this is why this option was explored, but it wasn't really good for the client. That report will have all that stuff in there, so that in the future, if you ever have to wonder why did we do it this way and why didn't we do it that way, the report will be a nice recap. And then if you decide to have me manage the portfolio of insurance, then every year I'm going to add a sheet to that report and say, this is what happened over the last year. If nothing changes, then we should still be on track based on the original projection. But if things change, then I'm going to write that in my report and say the cost increase or the interest decrease, and here's how it affects the policy, and here were the recommendations in order to maintain the policy as it was originally projected. And it'll say whether or not the client decided to take the recommendations or to ignore them. So.
Okay, great.
Wonderful. I have a couple of minutes left. This next section is something that I'm going to breeze through. In concept, it's actually quite easy to understand. A policy diversification is something that calculates, if you have multiple policies and you want to say you have 3 policies and you don't know which one is the most efficient, I'll actually calculate the cost structure for every policy, show what the trends are doing for the cost structures as the insureds get older, and when you have a sizable amount of insurance for an estate plan, relying on just one carrier is not ideal. And with this diversification analysis, I'll put together a table that looks something like this, and you can see the different carriers and what the face amounts are. You have to rely on my math, but I bring in the previous payments that were made. I know exactly when they were paid because I pull a dividend, or I'm sorry, I pull a premium history from the carrier. I put in exactly when premiums were paid. I factor in what the future premium payments are going to be, and then I come up with cost ratios and internal rate of return on a premium dollar. So while this whole life policy doesn't have the highest premiums of all the carriers, you have the least premium or the lowest premium requirement moving forward. If you look at the internal rate of return on the premium paid, it's actually one of the less efficient policies based on the face amount. And when you look at this first UL carrier, they have the highest premiums projected to be paid. But even though the premiums are the highest, if you look at the internal rate of return on the premium dollars paid, that particular carrier actually offers quite a strong value. And the cost ratio, simply put, is for every dollar you've paid into premium, how many dollars do you get in death benefit at that point in time. So for 5 years, or over the next 5 years, if you factor in what's been paid and what will be paid, if the insured die at that point, your cost ratio, for every dollar you've paid in over the life of the contract, you would make back $3.14. And that's just another metric to evaluate the policy and how cost-effective they are. And another service I do is premium optimization, where it's similar to the diversification analysis, but I actually calculate the cost structures for every policy, and then I use the illustrations from the carrier, or I find out what the trends are, and I request illustrations from the carrier to substantiate the analysis. And then once we're all on board, we execute the plan. And this is best described just by looking at the actual premium optimization analysis. And essentially what you have here is your control groups. This is what the client has right now. And based on the premiums that are going to be paid to age 95, age 100, and age 105, this is the face amount. And I have a target age that I have in mind. So no matter what happens, the target age on the premiums will based to this particular age. Okay. So you have a control group, and then you have your variables. Scenario A, I might shift premiums from one contract to another and reduce the face on this contract and not that one. So these are all different scenarios that I have laid out. And these colors, I'm going to get into that on the next slide, but it's a way for someone to say, with control group A, if the insureds were going to live to age 100, we are going to pay $8.3 million in premiums. But I don't need this kind of face amount. I need 16 million. So, or 17 million. So I run different scenarios reducing it, and naturally, because we're reducing the insurance, the premiums are reduced. But how do you calculate which is the most cost-effective way? And that's where these numbers come into play. If you look at the cost ratio, for every dollar you've paid in using this control group, this is what the client's currently, that's their current trajectory. So if the insured died at age 95, they would make back $3.8 for every dollar in premium. But if they use the premium optimization, they're going to get back, depending on what scenario they pick, $6 or $6.13 for every dollar they pay in, 6.84, as high as 9.46. And then you have to look at, well, what if they live beyond age 95? How about age 100 or age 105? So I color code this analysis because it just gives us the ability to look at which scenario offers the greatest value. And depending on how I structured it and what the target was, like for example, I purposely designed this scenario for age 95. So naturally, this policy or this scenario is going to offer the greatest cost ratio because I designed it for 95. But then if it goes beyond that, I'm not going to just give up and let the insurance or let the face amount go to waste. I'm going to have to maintain that face amount, and there's going to be an additional cost to carry it forward. And that's why it's not as efficient as, say, scenario E or scenario D. But when you look at what the analysis or the optimization does, this is what the client was expecting to pay, and this is what we're going to be able to reduce it to. And you can see this is real money. This isn't some pie-in-the-sky number. if this client goes from control A or control group A and he says, I want to do scenario B, you subtract 8.3 million from 5.3 million, the savings is $5 million after-tax money, and that's real money. I can mathematically prove how they're going to save $5 million. So it's a very, very effective analysis, and this is where a lot of value comes into play from a review perspective, because what you're looking on this, or when you look at this screen, what you're looking at is around 3 months worth of information gathering and work and analysis, and it's all summarized on one page. But you're able to look at this and save real money, and depending on which scenario you choose, will determine how much money you save based on what the client and the trusted advisor network is comfortable with. So that really wraps it up. I'm at 1:05. I went over by 5 minutes, but if you have any, does anyone have any questions about the premium optimization or policy diversification analyses?
I only have one.
I'm sorry, was there a question?
Yeah, the question is, do you offer your services in addition to what we're doing with Frank, or is that something that you work in conjunction with Frank in regards to this plan? Is this a separate service cost-wise?
That is correct. Frank is we'll refer business back and forth, but it's something that really should go hand in hand. Whenever I meet with a client and I'm looking at their insurance portfolio, and I'll ask them, when's the last time you've had your estate plan reviewed? And depending on what the answer is, or if they don't have anyone that they're working with, you really ought to have, that review to make sure that your goals are still in line. And when Frank looks at when he looks at an estate plan and he sees insurance in it, he obviously identifies whether or not my services would be a good fit for the client and refers me in for that. So we are 2 separate services, and that's how it operates.
And your fees are based on the amount of insurance that someone has, or it's an hourly fee, or how do you charge?
That's correct. The way my fees are calculated is asset-based, and it's based on the face amount. So it is it's the actual fee that I charge is 1/4 of 1% of the face amount.
And that's per session, per year, per hire?
All right. I'm sorry, that's a great question. That's for the initial analysis, and that includes anything that you need done to achieve your insurance portfolio goals. Everything I do is custom to the client. For example, this premium optimization chart that I put together, that is completely custom to this client and what they're trying to do. The next client, I'm not going to just erase this and put in the numbers. I'm going to create a whole different chart just to address their goals and concerns. And the fee that I charge initially is for whatever it takes so that you can make an informed decision. Moving forward, to manage the policies, the fee is reduced from 1/4% to 1/10%. And for 1/10%, I will call in the carrier every single month, make sure that the policy is performing the way it's supposed to be, and if it doesn't, I'll be able to rerun all the information that's necessary and then bring in the client and the trusted advisor team and make them aware that changes need to be made if they want to maintain the original projection.
And the initial consultation takes how long? Typically?
Yep, we can do it online. Depending on where you're located, I'll be happy to meet with you face-to-face. Whatever is most convenient is fine by me.
And how long does it take, time-wise?
It depends on the carrier. Some carriers are very good about getting me what I ask for, and they do it accurately. So I could do it as soon as 60 days. Other carriers tend to play some games, and you have to have more involvement in order to get the information. And this particular one is we're at like the 3.5-month mark.
Okay. All right. Thank you.
You're very welcome. Sally, did you have any questions?
No, I think I don't need to ask any more. This is very interesting, however.
Okay, great. Well, like I said, I'm willing to stick around after the presentation, and you can feel free to ask me anything then. So I'm going to turn it back over to Frank, unless anybody would like to make any comments or observations. All right. Well, Frank, it's all yours.
All right. Well, thank you very much, John. That was very helpful. Let me see if I can. Does everybody see my screen now?
No.
No.
No? Oh, you're still on me? Oh, you know what I did? I gave you the keyboard and mouse. I didn't give you the screen. Sorry about that, Frank. There you go.
Okay. All right. So I just want to insert here that the verification code for this presentation is 57. Thanks very much, John, for your presentation. It's been very interesting. I hope that everybody finds this useful and helpful. In case you want to get in touch with John, here's his contact information, or I can give it to you myself. If there's no further questions, I guess we'll finish up this presentation.
Well, Frank, I just want to say thank you very much for inviting me in, and it was a pleasure presenting to all of you today. And if you have any questions about the presentation, or if there's something in your own insurance portfolio that you have a question about, I'd be happy to have a conversation and see if I could be helpful.
All right. Well, thank you all very much for coming, and we'll look forward to seeing you at the next presentation.
We're all set.